Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. And what we're going to really focus on this week, ladies and gentlemen, is the big shift that's taken place in our overall investment strategy, why we're doing it now. In other words, really over the last 2 weeks, we started shifting assets in the portfolio, and the last week we've accelerated it. So we're going to go through both the long-term and the short-term reasons for the shift, how some of the symptoms in the market are suggesting to us that some of the core secular themes that we've been focused on for the better part of over a decade now are starting to perhaps break down a little bit. And then second, we're going to go through signs that there are a couple new long-term secular growth themes that are beginning to emerge after a 10-year absence from the stock market. So we're going to go through all of that today. Now, 2 or 3 weeks ago, for those that were on our weekly update, we noted that some anecdotal data, both at the town and the state level, was suggesting that after a plateauing and a slight increase of COVID cases in the month of March and April, we were about to experience a big downward shift in the number of COVID cases here in the US. So that started to ring alarm bells with us because we certainly know how the market has been viewing certain secular growth technology stocks, attributing them as work from home, even though we still really believe that those are mischaracterized. And that will play out over the next few years. But there's a few things that we wanted to really pay attention to. If we indeed got a big downward shift in COVID cases, how would that translate into GDP growth as it relates to the transmission of fiscal stimulus that we're seeing injected at the federal government level into the US economy? If cases had plateaued, the overall transmission mechanism and overall the impact, the delta impact of fiscal stimulus from the federal government would be somewhat blunted by COVID cases. But now that we were anticipating that big downward shift, we decided now was the time to start to increase the overall shift of the portfolio in away from technology and into some of these emerging secular growth themes. Now, I am using the term emerging secular growth themes for a very key reason here, ladies and gentlemen. The reason is very simple. We're not going into boom bust companies. We're not going into cyclical companies. What we're doing is we're trying to identify the new companies at the forefront of what we think could potentially be a new 5 to 7 year run in those stocks. So that's the very key difference. The other thing too, I will add is, I think for many years, as we were one of the top ranked investment strategies in 2017, 2018, 2019, 2020, everyone kind of said, well, okay, you're just technology. And, here's where I think you see the value of having a tactical investment strategy. Unlike the Cathie Woods of the world that are going to live and die by the technology sword or whatever their theme is, or way back in the day, we had Eric Sprott and all he did was focus on commodities to this day. We're going to go to where we think the broad, long-term secular growth opportunities are. And every decade we tend to get these shifts, and we're going to go through that today. Also, we're going to do a quick review of our investment process, just reminding clients why we don't necessarily react right away. We take things slow, we're patient, and then when we are ready to move, we move fast. Third, quick reminder, Wall Street remains bearish. That is good. We want to continue to see that bearish sentiment across Wall Street. And then, of course, even throughout all of these volatile shifts in the market, credit markets haven't blinked, and that's a really good thing. So real quick here, the performance has been just up and down the last 2 months. We were at one point down, close to 14% year to date. So we've chopped that in half, but we were down about, what was it, 1 or 2% last week. So we've retraced again. That is frustrating. We want to do better than that. We want to always be the #1 strategy in the country. Whether we look at that 2017 number, 2018, 2019, 2020, one of the things we pride ourselves on is not just outperforming the market, but being at the top of the pack. We are the most competitive team out there. And so, you know, when we see that down 7%, even though it's only really over the last 2 months, we take it seriously. And we're going to make sure that we make the moves that are necessary to get back to the top of the heap. And to do that, we need to understand where those secular growth themes are emerging that offer us not 6 months of runway, ladies and gentlemen. We're looking for the next 4 to 8 years of runway. That's very, very key. So overall, you can see here, over 1 year, though, we're up 75.18% versus 45 for the market, 30% outperformance versus after fees versus the S&P 500. Again, top of the heap versus our competition. And since inception, up 204.07%, generating 118% outperformance after fees. So we're proud of our track record, but as we've always said, through good times and through challenging times, we never rest on our past performance. And so we see, again, the fact that we're down year to date, we do not rest on that. We are going to make the shifts that we need to generate this type of, we want to generate outperformance for clients, both our existing clients that have enjoyed success so far, but our new clients who haven't enjoyed that success if you've come in since February. Rest assured, you guys are at the top of our mind. We want to make sure that a year from now, you said, wow, we stuck with it. And I love the results, and it just continues to be that consistent performance from 2017, 2018, 2019, and of course, 2020. Now, the big shift. We massively shifted the portfolio away from technology and software. We're going to go through those reasons why, and into energy and materials. I love this chart here on the right, ladies and gentlemen. It kind of shows the 10, not kind of, it shows the 10 companies by market value across each decade. One thing is consistent, and that is the lack of consistency. So we know in the 1970s, it was all about energy, the shortage, the blockades in the Middle East. And of course, we saw those companies dominate the top 10. In the 1980s, it was all about Japan. If you weren't in Japan, you were not outperforming. Then the Japan bubble popped and unwound. And then it became the 90s, which of course, as we all know, was tech and telecom. And then the 2000s came, and that was the commodity super cycle, the rise of China. Then the internet over the last decade. So the question is, over the next 10 years, what will be the theme when we look back? There are many, many signs that the commodity cycle is restarting. Now, in 2000 to 2009, it was all about building China. From 2020 to 2030, there's an emerging amount of evidence that the theme could be rebuilding the West, right? Not China. China's built out a lot of its modern infrastructure. The West needs to be rebuilt. That's going to require copper. That's going to require iron ore. That's going to require oil. I know we all shriek when we hear oil and gas and the environmental impact, but the reality is we're going to need all of it to rebuild the West. And that's what the theme is going to be. And a lot of times we have to pay attention to the technicals that time our shifts, right? So we don't want to leave tech too early, and we don't want to enter into commodities too early. So that's really what the last 3 months have been all about, is doing our homework on these themes and just waiting, biding our time to make the shift. Whenever we do make a shift, we're gonna underperform a little bit because we can't really explain to clients what we're thinking of doing because we don't want to show our hand. And then two, there is some frictional cost there as we exit certain positions and enter into new ones. But for those clients that are in the portfolios right now, I would be really, really excited. I can tell you my own personal portfolio, I am all in. And so we are certainly really excited about the prospects. Now, looking at the NASDAQ. So one of the things that we always look at are symptoms, right? We can talk about secular growth themes and disruption and all this stuff. The market always keeps us honest though. Overriding everything in our investment process, we pay attention to symptoms. So we can see here on the chart on the left, and it's a little, it's not super clear, but I'll kind of walk everyone through this. We had the initial downdraft in March. Now, a lot of clients ask us, why didn't we sell? It's easy. When you're in a dominant secular growth theme, you get a lot of these downdrafts. And guess what? It bounces back and makes new highs. Whenever you get a downdraft, though, it's important to not panic, not sell, but to assess the bounce. So what does that mean? We want to assess the vitality, the vigor, the volume, the breadth, the energy of the bounce when these stocks recover. We want to see them make new highs. We want to see most stocks participate, expanding breadth. So what happened? We bounced to point B, right? We bounced to point B. In other words, we made a lower high. And we started to notice, not only do we make a lower high in terms of breadth, in terms of relative performance to the S&P 500, but we started to keel over. We started that process of breaking back down about a week and a half ago. Now, the absolute price performance is also a little bit disturbing. What we see is a potential double top in the NASDAQ. Double tops from a technical perspective are worrisome. They can lead to sharp sell-offs, and they could also mark the end of a secular theme. So what we saw is a double top in the actual price action and lower highs in terms of the overall relative performance versus the S&P 500. So that's something we want to pay, weakening relative performance, and also double tops that we see in the notional price action. So again, a failed recovery pattern is what we started to notice in the NASDAQ, which is why we started to shift out of those assets. We saw the same thing. We look at the Russell 1000 growth relative to the Russell 1000 value. We saw, again, big rally, consolidation, breakdown, or sorry, sell off in March, then a nice bounce, but then it started to fade a little bit here. So again, assets sell off, we assess that recovery, and then we decide, do we want to buy, sell, or hold those assets? In this case, we started to unload those assets. We notice a weakening RS picture, relative strength picture in the overall framework. This brings us to ARK Invest, ladies and gentlemen. ARK Invest, one of the largest growth funds out there, combined with their different ETFs, manage close to 80 billion. It says 50 billion on the screen, but I believe it's close to 80 billion. I guess it depends on when you measure the value of their assets, but nevertheless, one of the largest growth products out there today. And as we all know, that fund is not performing well. And we've seen a huge run on that fund. Here's the problem. They own a lot of stocks, and they publish their holdings every single day. So what happens is, if you own any stocks that they own, you're in the firing range. You are in the firing line. And so what we wanted to make sure of over the last 2 weeks, there was a few things that we noticed here. A big top in ARK, then a failed double top underneath the main top. So we had the big top, double top, breakdown below the neckline, and most importantly, we noticed that we had a couple of holdings that were similar to ARK in terms, maybe like 3 or 4 stocks that were similar. Time to get out. No questions asked, because when you have a fund that is this large and facing potential redemptions, you want to make sure you don't own that inventory. That's what we call inventory risk. So we wanted to shift out of those assets. Again, we look at over the last couple of weeks, we wanted to look ahead of time and make sure that we avoided a lot of that pain. The other thing we've noticed is copper. And so for the first time, this is starting to get into what we see as the emerging theme on the other side. So we see a broad topping process with technology and software, and we're seeing a broad bottoming process with materials and energy, alluding to that giant commodity super cycle that may be starting to take shape. So we see here copper relative to semiconductors since 2013. It has been an elevator down, with one quick blip here in 2018 before resuming downward shift. What we noticed here for the first time, higher lows and then a breakout. And again, semiconductors are starting to break down on the other side. Then we look at copper relative to gold, and we see a breakout. Very important point, ladies and gentlemen. And also gold is starting to look a little bit better as well. Then we talk about the return of energy. So energy is emerging out of a 10-year bear market. So we see here is a higher low at the very bottom, and then almost like a reverse double bottom, a double bottom, but almost a reverse head and shoulders as we break out to the upside. So the same way a head and shoulders pattern can be very notorious on the top side, it's also very notorious on the bottom side. In other words, that's a very bullish picture. Now, what is the broad fundamental reason for owning energy? For the very first time in probably 50 years, actually the 70s are probably pretty similar. It was about 50 years, I guess, right? So we're seeing an accelerating economy where supply of oil cannot respond to the massively increasing amount of demand that's taking place in the global economy. What's happened? Energy production companies are notorious at drilling too much, right? The mantra from the Trump era was drill, baby, drill. Guess what? Trump was very friendly to energy companies, but they weren't very friendly to themselves because they drilled themselves into a supply glut, and the stocks did terrible. Biden is cracking down on the issuance of new permits. So if you're a new driller, you're sitting on land and you want to develop that production, it's going to be very hard. And so what does that mean? So that means that the overall industry cannot respond with new wells at the same rate that it did 5 or 6 years ago, at a point where the economy is potentially going into gangbusters mode. So in other words, we've already seen that demand for oil and petroleum past 2019 levels. Now we're at a point where supply can't even respond to it. And OPEC suddenly has discipline. This is what we saw in the late 90s. This is what we saw when OPEC decided, you know what, enough is enough, time to get disciplined, right as China emerged in its global growth cycle from 2000 to 2010. So what, again, the Biden administration is probably the most bullish thing because it's forcing discipline, drill discipline on the existing players in the oil patch, and accelerating demand, increased discipline from OPEC, and no supply response. So again, this is very good for oil prices and by proxy, oil service and production companies. So let's take a look at energy on an equal weight cap basis. So what we see here is equal weight energy relative to the cap weighted energy is beginning to break out. That simply means that more and more energy companies are participating in the rally, expanding breadth. That's something we want to see. At the same time, we see the NASDAQ relative to the S&P 500 breaking down. Again, notice the NASDAQ, a broad top here from a relative price perspective. You look at the overall notional price, yeah, there's that double top, but not as bad looking as this chart, though, when you look at it from an RS standpoint versus the S&P 500. And then, of course, from a broad market standpoint, Wall Street remains bearish, ladies and gentlemen. If we look at strategists' price targets, they still need to catch up. They're below where the S&P 500 is trading historically. That is bullish, not bearish. Positive symptoms. Again, we haven't even updated this chart, ladies and gentlemen. UPS has just continued to go up. When you see the transport sector making new highs, that's Dow theory. That's good for the economy. That's good for the market overall. Very positive symptoms there. And then last but certainly not least, the credit markets remain incredibly healthy. So we've talked a lot today about the broad shifts. Very important. Materials and energy are on the precipice of a new 5 to 10 year secular bull cycle. That is what our work suggests. Now, if for some reason there are symptoms that go against that theory over the next 6 to 12 months, we'll sell, right? We're tactical. We will sell. We pay attention to the symptoms before anything else. So we're not afraid to admit when we're wrong. But technology, after all of our investors that have been with us for a long time have enjoyed that run, there are signs that there is a broad topping out process with that specific area of the market, while industrials, energy, financials, and of course materials are on the sort of breaking out of that 10-year bear market. So when assets break out of 10-year bear markets, it's important to pay attention to that, because that can go for a 10-year run. So that's our story today. What we wanted to really kind of focus on was making sure that clients understood the reasons why that shift was taking place. It's not taking place because we're, worried about trying to just sell to sell because we underperformed for a month. That is absolutely not why. We've underperformed like this before. December, Q4 of 2018, we had a bad quarter. We get these bad quarters. That's normal. That's part of portfolio management. You're going to have that. Broadly speaking, though, we wanted to make sure the portfolio was positioned for the new secular cycle that is about to take place in commodities. And that's how we're shifting the portfolio. So please, ladies and gentlemen, if you have any questions or concerns, please feel free to reach out to your advisor. Please feel free to reach out to our offices here at LifePro, 888-543-3776. You can also reach me on my cell phone at 858-354-5114. Thank you so much for all your business, your patience, and of course, your flexibility as we go through this transition process. So thank you again, and have an absolutely fantastic week.